back to Community Corner Podcast, Personal Finance Edition. I'm Olivia, joined by my co-host Rashmi.
Today, we're going to unpack two similar investment types, ETFs and mutual funds. They're both considered to be on the safer side for investing and seem somewhat similar.
So let's start by figuring out what they are, how they work, and who they apply to.
Mutual funds first. These are investments that let you pool money with other investors to mutually buy into stocks, bonds, or other investments. I'm starting to see a trend of names that match the meaning. I like it.
Yeah, and no need for extra confusion because mutual funds are run by professional money managers who decide what to buy and when to sell. But you also have exposure to all the investments within the fund at all times and are guaranteed any income that is generated. So it's more of a hands-off approach of putting your money into something and having somebody else monitor it for you.
Yeah, and there's a lot of different types of mutual funds. They split off into two main groups, actively managed and index funds. Actively managed funds are trying to beat the market's returns with their managers picking securities that they believe will outperform the market. These are also more expensive. On the other hand, index funds are meant to just track a certain index, like the S&P 500, for example. They're lower cost, but still ensure you that you will earn around the same as major players in the market are earning.
For types of mutual funds, there are some common ones that focus on investing in traditional assets with usual strategies. Essentially, they do the usual investments that you would expect of a portfolio. The majority of funds are part of this category. Specialty mutual funds have a more defined objective with non-traditional investments and strategies, like investing in commodities or making investments based on certain goals, like being environmentally friendly.
So what are some specific types of funds? There are equity funds, which invest in U.S. or foreign stocks, usually defined by the size of companies they invest in. Fixed income funds are funds that buy investments with a fixed rate of return, for example, government bonds. Target date funds have a mix of investments within them, shifting as necessary for them to reach the amount of needed money for the target date, usually retirement.
Money market funds usually invest in forms of cash like U.S. Treasury bills or certificates of deposit. These are lower risk and usually have better returns than savings accounts, with the catch of not being insured of the FDIC. Environmental, social, and governance or ESG funds are funds that consider non-economic issues in their selection of investments as well, such as human rights or religious views. This could also include avoiding certain industries like alcohol or tobacco. Asset allocation funds allocate a specific amount of fixed income and equities based on the fund's goal, typically offering both income and growth potential.
Now, there are many more types of funds to choose from, and these are only a few. Choosing can be hard, so we have a few steps for you to consider before making a decision on mutual funds.
Always consider the expenses for the funds you want to invest in, which ties right into remembering about taxes, which can be affected by your investments. And understand your investment goals, similar to your financial goals, which will dictate what type of funds you might want to invest in or to avoid investing in.
But perhaps ETFs are a better fit for you. Exchange-traded funds, known as ETFs, are pooled investment securities operating much like mutual funds. They're referred to as ETFs because they are traded on an exchange, just like stocks. ETF share prices will change throughout the day as shares are bought and sold.
Similar to mutual funds, ETFs can consist of various assets within themselves, diversifying the investment itself. They can hold hundreds or even thousands of stocks across industries or restricted to a certain part of the market. There are even global options alongside national ones.
The two main types of ETFs are active and passive ETFs, with actively managed ETFs having portfolio managers deciding specifically what to include in a portfolio. Passively managed ETFs want to replicate performance of an index, perhaps a broad one, or a certain sector or trend visible on the market.
For example, there are approximately 9 ETFs focused on passively following trends with gold mining stocks, looking at only companies engaged in gold mining.
There's a variety of active ETFs as well. Bond ETFs focused on providing regular income by relying on performance of various types of bonds without the maturity date associated with individual bonds and at a discount from actual bond prices. Currency ETFs are investment pools and track performance of current currency pairs from both domestic and foreign locations, which speculate based on what developments are occurring in countries and help avoid volatility and inflation effects.
Inverse ETFs aim to earn gains from stock declines by shorting stocks, essentially making bets that a stock will lose value and selling it before that happens to rebuy at a lower price. Market declines will inversely increase ETFs. Industry ETFs, also known as sector ETFs, are funds focused on specific parts of the market, for example, the tech or healthcare sector. And commodity ETFs invest in commodities, usually providing a cushion during a downturn in the stock market and cheaper than holding the actual physical commodity.
When it comes to investing in ETFs, it's important to consider what sort of strategy and type of ETF matches your investment goals. Then, to look into what locations, online or traditional, will provide the space to invest. And remember to keep in mind the initial financial burden and any potential tax influences.
Now, ETFs and mutual funds might sound quite similar, but there is one major difference to be aware of. It's in the name of ETFs. They are exchange traded, meaning they can be bought and sold throughout the day just like any other stock. On the contrary, mutual funds can only be bought or sold once a day after trading closes by contacting your mutual fund company.
So now let's compare the pros and cons of both. ETFs are more liquid because you can sell them during the day when you see disaster coming, but mutual funds, on the other hand, can only be traded once the day ends. So disaster might not be avoidable in that case. ETFs usually have lower costs associated with them as well, and are more transparent. Since ETFs are traded like stocks, you can treat them like so, and they're also more tax efficient on average.
However, ETF platforms may incur a commission fee or a spread fee when buying or selling. This refers to the difference between the price you pay to buy in and buy out, and the larger the spread, the larger the cost. ETFs are also traded with slight premiums and discounts when sold or bought at any given moment. Mutual funds, on the other hand, are always transacted at the net asset value since they're traded at the end of the day and there's a chance to figure out the true value at that time. Essentially, there's more time for the value to be assessed fairly, removing any blurry margins.
Well, neither investment is perfect, and both can be effective and successful. It really comes down to the individual and what they value most. If you prefer to be more flexible, favor lower expense ratios, and don't mind premiums or discounts possibly working at your disadvantage, then ETFs are a good fit for you.
And if you're more worried about additional costs from commissions and spreads and want to trade at exact value, mutual funds are a better fit. But these two options aren't mutually exclusive. You can also choose to invest in both for some time and then decide to add more of one type or sell out the other if you find ETFs or mutual funds more fitting to your investing style and investing goals.
Why don't we take a look at how mutual funds and ETFs have been going in the past year? We're using data from the US News and World Report on the past year.
The 5 most popular types of ETFs are long-term bond, short-term bond, small growth, high-yield bond, and large growth, exactly the same as mutual funds for the top 5 most popular types. But equity precious metals are rated higher for ETFs, and target date retirement funds are rated higher for mutual funds. This makes sense considering that ETFs are a good way to invest in more volatile stocks with a cushion, and that mutual funds can be a sort of retirement investment with target date funds.
Yep. Again, we see some overlap with the most popular fund families, the top 4 being iShares, JP Morgan, Fidelity Investments, and Jackson National for both investment types. This can be attributed to the fact that investments do aim to be successful in gaining money, and these are some of the most prosperous companies and areas for growth.
Why don't we check out how stock-based funds are ranked? I somewhat associate both mutual funds and ETFs as a safer alternative to investing in individual stocks.
Yeah, you're not alone in that. I also see both fund types as a safer way to invest in stocks, and a great starting place for new investors since it's more spread out. On that note about stocks, the top ranked large growth ETFs are iShares, ESG Advanced, then Direxon Nasdaq 100, and then JP Morgan US Momentum Factor. These are all funds that make sense. In terms of large value for ETFs, JP Morgan Diversified Return US EQ is first, then Invesco C&P 100 Equal Weight, and then Fidelity Dividend ETF. Any surprises to you, Olivia?
No, that all makes sense because these are companies you'd expect ETFs to be following to get the most returns possible. And in terms of mutual funds, the top-ranked large growth ones are Amana Trust Growth, which is actually one of these seclusive mutual funds that is based on Muslim beliefs, which is great to see that all of these mutual funds have a chance at actually being successful, even if you want to avoid a certain industry. And then after that is the BNY Mellon Large Cap Securities Fund, and then Vontobel US Equity Institutional Fund. For large value mutual funds, Fidelity New Millennium Fund is first, followed by Vanguard Equity Fund and Hamlin High Dividend Equity Fund. These funds are more foreign to me than the top-ranked ETFs, but they still make sense.
Yeah, for me too. They seem a little foreign. But though taking a look at the specifics for each fund, it's still not that surprising. Overall, I personally think I would prefer mutual funds as more long-term investments. I think I'd start by investing in mutual funds, then possibly ETFs if I feel the need or want to do so. How about you?
I feel the same way. I think that mutual funds to me feel safer, and I'd rather start with a mutual fund, probably a more broad one, and then possibly go into ETFs by going into more passive ETFs that are just following trends, and then maybe move into the more active ETFs or mutual funds.
Yeah, I agree, especially since mutual funds are more like a professionally led. I think it's a good way to start and just see how the area works, and then ETFs is more hands-on.
Yeah, that's a great point. I guess we'll see in the future. Thanks for tuning in to today's episode of Community Corner Podcast, Personal Finance Edition. This is Olivia and Rashmi.
Cashing out.